Retirement. Ah, it sounds so great. After working hard your whole life, it's a chance to relax and really enjoy your independence. Maybe you'd like to travel, see your family more often, or build that cabin you've always dreamed about. Hey, you could do some fishing. Or perhaps you'd like to donate to support your favorite cause. And wouldn't it be great to help your grandkids with college? When you visualize your retirement, there are probably many things you dream about happening during your golden years. But there are quite a few challenges to resolve before you can reach your goals. Ensuring that you have the finances you need to support the lifestyle you want is a tricky proposition. There's a lot to consider. First, the good news. We're living longer. The average lifespan today in the U.S. is nearly 79. That compares to a lifespan of only 62 back when Social Security was first created in 1935. That means you must find a way to make your money last even longer than ever before. There's also the so-called long life penalty, also known as inflation. And of course, you need to be concerned about rising taxes, healthcare costs, and the unpredictability of the stock market. Mix in some poor advice and bad investment decisions along the way, and it's easy to see how both your dreams and your financial security could be in jeopardy. So what is the best way to plan for your retirement? What are the factors to consider, and who should you include in your decision-making process? Do you need a degree in finance or just blind faith? What you really need is a retirement plan that balances the risk level you're comfortable with, offers moderate returns, and features the liquidity and protection you desire. Impossible? Well, such a plan does exist, and it's easy as ABC. This plan features an asset class that creates steady market-linked gains and no losses even if the market is down. But how is this possible? Fixed indexed annuities, otherwise known as FIAs. Fixed indexed annuities offer a minimum protected interest rate, along with an interest rate linked to a major stock market index, such as the S&P 500 or the Dow. In up years, you'll receive a percentage of the market's gains. And perhaps most importantly, in down years, your principal and previously earned interest is secure. To understand a bit more about how the ABC planning system works, let's think about what the ideal investment would look like in a perfect world. It would return double-digit gains, have 100% liquidity, and your money would be completely protected and fully guaranteed. Unfortunately, no single type of investment has all three of these features. But with the ABC planning model, you can earn solid gains while keeping a percentage of your retirement funds both liquid and protected. How? Start by thinking about the money you save for retirement in one of three categories: A, B, and C. To make them easier to track, let's give them each a color. A will be yellow, B will be green, and category C is red. Category A features funds that earn a low interest rate. The principal is protected and have easy liquidity, so you can get to your money anytime. This includes things like cash deposits in bank assets, like CDs and savings accounts. Category B features moderate liquidity and returns, plus an interest rate linked to market indexes, getting some of the market-type returns, but not exposing the principal to market-type losses. This category features the upside potential and protection of fixed-indexed annuities. The final category, Category C, is your growth column. It features stock and bond type risk. The majority of money found in this column is found in traditional 401ks and IRAs. The earning potential of these assets can be substantial, but the risk is equally significant. If you watched the balance of your 401k and Roth accounts rock wildly up and down during a market correction or large recession, you know the danger of having all your eggs in just one basket, the risk basket. The key to financial security in your retirement is to make strategic, informed decisions and intelligently divide and prioritize your assets into each of the three categories. But don't wait. When the Social Security system was originally created, the ratio of workers to recipients was 159 to 1. Today, that ratio is 2.9 to 1. By 2030, it will be 2 to 1. and the Social Security Trust Fund, which helps guarantee the solvency of the program, is widely expected to be insolvent as soon as 2033. Putting your head in the sand and hoping for the best is not a strategy. But the ABC planning model is, and is surprisingly easy to understand. Simply put, the ABC planning model helps you decide how much of your retirement funds you want liquid, how much protection you want, and your tolerance for risk. Using that information, you can easily choose how to allocate your assets the way that makes you feel most confident. First, decide what percentage of your money would you like to have available to you at all times and protected at the bank. That is the percentage you should place in Category A. Next, decide what percentage you can tolerate being invested in stock or bond type risk in Category C assets. After deciding how much goes in Categories A and C, the percentage that is left goes in Category B, the green column featuring indexed annuities. It's that simple. To see why FIAs are such an attractive alternative for retirement savings, let's take a closer look at how they work. With fixed indexed annuities, in up years, you'll receive a percentage of the market's gains. The better the market performs, the higher your potential returns. But perhaps more importantly, if the market suffered a huge loss, like in 2008, your principal and previous interest would be protected. No matter how the market performs, you cannot lose your principal nor your previous gains. To illustrate further, let's look at a 4-year hypothetical example. In year 1, let's say the market gains 10%. Your Category B money, which was put in the indexed annuities, would earn a percentage of that gain. Let's say in this example that the insurance company capped your FIA participation at 5%. Now imagine that during the second year, the market suffers a huge downturn, let's say 30%. Ouch! In a typical 401k or IRA, you would have substantial losses. But in this example, your account would not lose a cent. The reason? Because the overriding characteristic of fixed indexed annuities is the ability to protect your gains. Even though you wouldn't have earned any additional interest in a down year like this, both your principal and the 5% you earned on it last year is untouched by the market's downturn. Now imagine that in the third year, the market came back and earned 5%. Accordingly, the company would credit you with interest again. As before, since our hypothetical cap was 5%, you are credited with the full 5% interest. In the fourth and final year of our example, imagine the market went up 15%. You would once again receive the interest cap of 5%. So at the end of our 4-year example, you can see that your account was both protected and earned a steady, consistent return, regardless of a significant downturn in the market. In fact, at the end of the 4-year period, your account had earned a little more than 15% because the 5% that was awarded in 3 of the 4 years was compounded. In our example, it is important to note that if you were only invested in a traditional 401k during this period, by the end of the 4th year, your account still would not have even recovered your lost principal, much less the significant interest awarded. So there you have it. The benefits of saving retirement dollars in indexed annuities are substantial and easy to see. In short, by accepting a cap on possible market gains, your exposure to risk in the market is minimized and your ability to earn a competitive interest rate on your dollars is enhanced. That's the power of the ABC planning model and the best way to ensure your financial future with the stability and earning power of indexed annuities.